Okay, so thank you everybody for joining our webinar. We have a series of webinars. This is Introduction to Social Security, and let's get right into it. All right, we have a disclaimer here, not necessarily a legal disclaimer, but just a disclaimer I wanted to put in just to make this a little bit easier going forward. So this is a general overview. It's not meant to give advice for any one person or situation. Social Security can be surprisingly complicated. Real life cases often depend on a lot of moving parts. I'm going to do my best to keep things simple and easy to follow, but some parts can get a little tricky and some terms are going to sound repetitive. That repetition is intentional and helps build a solid understanding of the topic. So as I go through this, some of the information might be a little bit, what am I talking about? But as I go on to a subsequent slide, it'll hopefully kick in and that piece of information will become a little bit more understandable. Okay, why does Social Security matter? It's the largest source of guaranteed income for many families, provides inflation protected income for life. It's a key part of retirement planning alongside savings and pensions. How is Social Security calculated? You know, I used to do Social Security seminars in the past, and many of the presentations would always talk about, well, you take the highest 35 years of your earnings adjusted for inflation, and this is how it's calculated. Well, I wanted to dive in a little bit farther into how it's actually done, and we're going to do that over the next couple of slides. Oops, and it's pretty interesting how it actually works. So each year's of earnings are used to find your average index monthly earnings or your AIM. AIM is run through a formula with bend points that determine your primary insurance amount or your PIA. We're going to, hear that a lot. That's interchangeable with your FRA, which is your full retirement age. And don't worry, we're going to talk about that a lot over the next, many slides here. In 2025, the formula to calculate your primary insurance amount is they're going to take 90% of the first 1174, 32% of 1174 through 778, and anything over 7,078, they're going to take 15% of that average monthly earnings amount to calculate what you're going to get on a monthly basis. And we have examples going forward, so don't worry too much about that right now. It's going to replace a bigger fraction of lower earnings and only a smaller fraction of higher earnings. And you can see that by the fact that you're only going to get 15% above that last threshold. The result equals your monthly payment at your full retirement age or your FRA. Your primary insurance amount, the PIA, is what you will get at your FRA or 100% of your eligible payment. Early or delayed claiming adjusts that amount up or down from that FRA point. When is your full retirement age? If you were born in 1960 or later, your FRA is age 67. Since the majority of remaining filers will have an FRA of 67, we're going to focus on that year. So at age 67, for most people, that's when you're going to get 100% of what you're eligible to get. Only people born in that 1955 to 1959 range are still in that FRA 66, but not yet 70, and can still earn 8% per year until age 70 if they have not yet filed. Everyone born earlier than 1955 has already reached age 70, right? Think about it. If I was born before 1955, I'm already 70. I would have already filed. But if I was born in that range, maybe I'm 68, 69, and I haven't filed yet, and I'm still allowing my amount, the payout to accrue by 8% a year until I hit age 70. And we'll get into some of those ranges as we move on through the slides here. So at your full retirement age, your FRA, that's when you get 100% of your eligible payment, which is also known as your primary insurance amount. It's kind of synonymous. Your PIA and your FRA, kind of the same thing as when you hit 100% of what they're going to give you. If you file earlier than your FRA, your monthly payment will be reduced. If you file after your FRA, your payment will increase. It's not just about the year. You can choose the specific month as well. This means your payment goes up or down slightly for each month you file before or after your FRA. You can file as early as 62 or as late as age 70. How do we calculate your average monthly earnings? This is also pretty interesting. So you take your 35 years of your highest earnings, then you take the highest 30, take your 35 years of highest earnings, and take those 35 years of highest earnings and you index them up and sum them up. So you might go back and say, hey, 30 years ago, here's one of my earnings, but now I have to index that up for wage inflation and crank it up to today's dollars to get that number. And then I might go back 15 years ago and take that high point and bring that up to today's wage inflation. I bring all those numbers up to today, and then I have to divide that by 35 years times 12 months. So as an example, if my total indexed earnings over my best 35 years was 2.1 million, so I take all those 35 years, bring them all the way up to today's wage dollars, 2.1 million, and I divide that by 420 months, I'm going to get an average monthly earnings number of $5,000. That's how they do it. So how do we get our number? And we're going to, the next slide, we've got a pretty good example, but we're going to take that number and apply it to these bend points. So SSA, Social Security Administration, it places a higher percentage of income for lower earners. The formula uses bend points that apply your average monthly earnings to figure out what your primary insurance amount. These bend points determine how much you're going to get every month. So let's take a look at those ratios again, or those bend points. The first, basically 1,200, they're going to give you 90% of replacement earnings. But then from 1,200 to 71, 7,200, they're going to give you only 32%. Over 7,200, you're only going to get 15%. So the more you make, the more you're going to get, but you're going to get it at a decreasing rate. So this next slide shows a great example of that. Here's somebody, we're going to compare somebody that made 150,000 versus $50,000. So you might think, hey, I made 3 times as much as the person making 50. My Social Security should be, roughly 3 times as much. Well, as we saw by the formula, it doesn't quite work out that way. So the guy making $50,000, his monthly average earnings was about $4,200. So when we put it through all of our bend points, it comes out to about $2,000 a month. This replaces about 49% or about half of his pre-retirement income. Now, the guy making $150,000 a year, his monthly earnings are about $12,500 a month, which is about 3 times as much. But when we put him through all the bend points, his monthly average earnings only comes out to, his crediting on his monthly average earnings only comes out to 3,800, and then it only replaces about 30% of his pre-retirement income. So he doesn't even get 2 times the amount of Social Security as somebody making 1/3 of his wages. And that's how the system is designed. So lower earners get a higher replacement rate. Higher earners get bigger checks, but they get a smaller percentage replaced. So the system was designed for that for, I think, really a couple reasons. The idea was, excuse me, the thought process, if you're making $150,000 a year, you'd have more, discretionary disposable income to put money in a 401k, to invest in other sources. if you're only making 50,000 a year or less, Social Security was designed to replace a higher amount of that income. Also, if you were in a situation where you paid everybody that was making 100 or 150,000 a year, $6,000, $7,000 a month in Social Security wages, the system wouldn't be able to support that, and it would probably, be defunct at this point. Claiming options. If we can take Social Security as early as 62 and as late as 70. So our range is between 62 and 70. Most people, their full retirement age that haven't claimed is going to be 67. So if I take it at 62, what happens? Well, I'm going to get about 70 to 75% of what I would get at my full retirement age, which is going to be my 100% level. So my full retirement age, we're assuming here it's going to be 67. That's when I get my 100%. This is kind of the baseline for all adjustments. If I delay to age 70, I'm going to get 8% per year above my FRA. So assuming, once again, my FRA is at 67, every year I delay, I'm going to get an 8% increase. So I can get up to 124% if my FRA was 67, if I delay to age 70. So if I filed at age 68, I get 108%. If I did it at 69, I get 116%. If my FRA was at 66, and if I delayed to age 70, I would be able to get up to 132% of my baseline 100% benefit. Recall your FRAs when you get 100% of your payout. Survivor benefits. A surviving spouse can claim the higher of their own benefit or a deceased spouse's. Widows can benefit. It can start as early as age 60. So if you have a deceased spouse or a widower, if you're age 60, you can claim on theirs if theirs is higher than yours. You can also claim an ex-spouse's Social Security if you're not remarried and you had been married to them for 10 years. You'll always get more if you wait until your full retirement age, but not more after their full retirement age. It all goes based upon your own full retirement age. So all these little rules going forward, you'll always have more flexibility. You'll always get more money if you wait till your own full retirement age. Just a little, if you take nothing more out of this presentation, your FRA is kind of your key. Whatever you do, if you're working while you're taking Social Security, if you're claiming anybody else's benefit, an ex-spouse's, a widow benefit, whatever the case might be, you always want to wait till your FRA if you can, because you're always going to maximize out whatever payout that you're eligible to get. It's just kind of the way the system works. That's the easiest way to look at this. When should you file? Well, you want to consider a couple things. What's your health status? What's your family longevity? What's your current and future income needs? Do you plan to keep working? What's your overall retirement assets? I kind of joke with people when they tell me, when should I take Social Security? I say, well, if you tell me exactly when you're going to pass on, I can tell you exactly when to take Social Security. It would be an easy thing to solve. I mean, it's a math question, but nobody knows exactly when that day is going to happen. Break-even age. Claim it at 62 versus 67. Claim it at 62 gives you that reduced monthly benefit. Remember, about 70, 75% of your FRA. Your break-even typically is around 78 to 80. If you live past this, waiting until your FRA or later often pays off. Shorter life expectancy, you want to claim earlier. Claiming earlier may make sense. So here's how I would look at this. If I'm going to wait till my full retirement age, instead of taking it at age 62, my break-even's age, let's say about 79, to take the midpoint. So if I wait till 67 versus taking it at 62, I hope I live to 79. If I die at 75, 76, 77, I would have been better off taking it at 62. So part of the factors that go into this is, well, do I have a good family history? Am I in good health? Do I think I'm going to live past 79 or 80? What's my asset base? If I have a lot of assets, maybe I can delay filing until 67, 70 years old. If I need the income, maybe I have to take it at 62 or 63 or 64. So there's some other things that go into it rather than just longevity. Break even age, delay until 70. Each year after your FRA adds 8% credits. So my break even compared to claiming it my full retirement age, which we're going to assume is 67, is usually around 82 to 83. So if longevity is expected, delaying till 70 maximizes your lifetime payout. It also provides higher survivor payments for your spouse. So if I was thinking, well, I'm going to wait till age 70 to claim my Social Security versus taking it at my full retirement age at 67. Well, what are my odds? What's my break even? Well, I got to pretty much make it to age 83. If I think I'm going to make it to age 90 because my family all passed away at 90 and I'm in really good health and I don't need the Social Security right now, maybe I wait until age 70 or 78, or I'm sorry, 68, 69 and claim it then and, play the odds. But it's kind of nice to know what the break even points are to kind of get an idea of what you're getting yourself into before you actually file. Because once you file, it's pretty hard to unwind it. If you keep working before your full retirement age, $1 is withheld for every $2 earned above a very low limit, about $27,000 in 2025. It's kind of an earnings test. So once again, this goes back to if you wait till your full retirement age, you don't really get restricted. So at your FRA, this earnings test disappears. So if I wait till my full retirement age and continue to work and file for Social Security, nothing goes against me. I can claim my full amount. Now, let's say you claim at age 64 and you continue to work and you make, 100 grand a year. They're going to hold back that money, but at your full retirement age, they're going to recalculate what you would have gotten at age 64, and then they're going to start paying you that amount that you would have got at age 64 going forward. They're not going to give you a refund or here's the money we held back. You don't get it back. They're just going to start paying you that amount you would have gotten at age 64 going forward. So it's important for planning, full and part-time work just to realize that if you start doing this, they're going to start holding, money back if you do it before your FRA. Okay, how is it taxed? Up to 50% of your payments are taxable if your income is above 25K if you're single, 32,000 if you're married. Up to 85% is taxable if it's over 34,000 if you're single, and above 44,000 if you're married. These are not indexed for inflation. So you get taxed at a pretty high rate pretty early. So, how do you get around that? Well, you can have money in Roth IRAs and there's other ways of getting around it, but for the most part, you're going to pay tax on Social Security. It's kind of crazy. You've already paid tax on the money, but they hit you with a pretty low threshold. Now, under the new tax bill that they passed, you get a $4,000 credit against Social Security. So you get an offset, which is nice, but it's not full, tax-free, in that regard. How do you improve your earnings record? Well, check your Social Security statement online to ensure your earnings history is accurate. Make sure missing years can reduce payments, but remember it's a moving average of 35 years. So, if you have one missing year, it's not going to dramatically, reduce anything that might be happening. Additional years of work may increase payments, but once again, if you have a couple of missing or you want to add a couple of years, even if you're making a lot of money for a couple of years, because it's a moving average, it might slightly increase what your payout's going to be, but it's not going to dramatically move the needle. All right, claiming strategies. Here's a couple of examples of claiming strategies. There's a spousal rule. Lower earning spouses can claim 50% of the higher earners' full retirement amount, their FRA payment. Example, high earners FRA payment is $2,000. Assume the spousal payment at their FRA is $700. The spouse payment under the 50% rule, they can take $1,000 at their FRA. So timing is important. The spousal benefit is reduced if they claim it early. So once again, it goes back to the FRA. So if you have a spouse who is lower income, they can claim up to 50% of the higher income spouse at their FRA if you wait till your FRA. This is a good one. I think this is a key one that a lot of people miss out. Higher earner delays. So it's often optimal for the higher earner to delay filing until age 70. This optimizes the monthly check and survivor payment. It ensures the household has a higher guaranteed income for life. If the spouse who claimed at 70 passes away at 71, for example, the surviving spouse receives a higher payment for the rest of their life. So you might have a situation where maybe one spouse, if they waited until 70, would get 3,800 in Social Security. And the other spouse, let's say, was only going to get $2,000. You know, the higher earning spouse, they wait until 70, they claim the 3,800. And if anything were to happen to the higher earner spouse at any point in time, the surviving spouse can then claim that higher benefit of the 3,800 and take that for the rest of their life. So even if the person passed away at 71 and the other spouse, let's say the other spouse is 65 and they live to 100, they can take that 3,800 that would be indexed for inflation going forward for the next 35 years, kind of like a second to die annuity policy. So that's a kind of a key provision, I think, is probably the best way of utilizing, delaying till 70. Right. Bridging the retirement gap. Social Security alone usually doesn't cover all expenses in retirement. Use retirement assets, IRAs, 401ks to fund the gap. Timing of Social Security matters. Take it earlier if your asset base is low. You may be able to delay filing if your asset base is substantial. Proper planning ensures a sustainable income stream throughout retirement. Obviously, if you need income and you don't have a lot of assets, you might have to file at 62 or 63, to make ends meet. But if you have, several million in assets and a low cash burn rate, you might want to wait till age 70 to maximize the Social Security amount because you don't need the assets. You don't need the income, rather. And you can let your assets, fund your income needs that aren't that high anyway. So there's a lot of moving factors that go into play. All right, next steps. Review your earnings record. Run retirement income scenarios. Coordinate with your spouse. Talk to a financial advisor. If anybody has any questions, you can always reach our website by scanning the QR code, or you can reach us by our phone number, by our website. We're in Burr Ridge. Feel free to give us a call or email us if you have any questions. We'd like to meet about any questions about Social Security planning, about how to fund an income gap with any retirement assets. We'll be more than happy to sit down and talk with you. Also, we're going to have another upcoming webinar in the end of November, I believe, right, Mike? On estate planning, basics of estate planning. So stay tuned for that invite. We hope to see you there. Thank you very much.